Welcome. If you're listening, you want to get up to speed quickly on important changes, and today we're looking at a big one in international tax.
That's right. A really significant shift happening here in the UK.
We're talking about the UK's resident non-domiciled regime, the R&D regime. It's being abolished.
Correct. Effective April 5th, 2025. And this is going to have, well, pretty substantial consequences for anyone with ties to the UK and other countries.
Okay, so let's unpack that. We've looked at the official details, expert analysis on the implications, and maybe some alternatives for people affected. Our goal today, just give you a clear, concise understanding of what this end of the R&D regime means and, explore some options. We want you feeling informed.
Absolutely. Empowered, even. So first things first, what was the R&D regime?
Good starting point.
Well, fundamentally, it gave tax benefits to international folks living here whose permanent home, their domicile, was legally outside the UK.
Allowed them to shield foreign income and gains from UK tax in many cases.
Exactly, under certain conditions. But, like we said, that's being abolished. Gone.
Right. So what are the key tax changes now, the implications under this new system? Sounds like it varies.
It does vary. For new arrivals, people coming to the UK,
Yeah.
there's a potential 100% relief on eligible foreign income and gains fig for their first 4 years here.
Okay, 4 years relief. Any catches?
Yes, a big one. They can't have been UK resident in the 10 tax years before they arrived.
10 years prior non-residents. Got it. That helps newcomers, but what about people already here using the R&D rules who maybe don't qualify for that 4-year break?
Well, for those former R&D taxpayers not eligible for the new 4-year FI relief, things change quite a bit.
How so?
Any new FI arising after April 5th, 2025, it'll just be taxed at standard UK rates, same as any other UK resident.
Wow. So that non-dumb advantage on future foreign income, it just disappears for them.
Pretty much, yes. The preferential treatment based on domicile is gone for income and gains arising from that date onwards.
That is a major shift.
Yes.
Now, I've also read about something called a temporary repatriation facility, TRF.
Yes, the TRF. It's aimed at people who use the old remittance basis, only paying UK tax when they brought foreign money in.
Right.
If they have untaxed FI generated before April 6, 2025, and they're still UK resident, they can choose to bring that money into the UK within a specific window.
And pay tax on it.
Yes, but at a reduced rate. They elect to designate it for this facility.
Reduced rates. Okay, that sounds potentially useful. What kind of reduction are we talking?
It's set at 12% for the first 2 tax years, 2025-26 and 2026-27.
12%.
Then it goes up to 15% for the 2027-28 tax year. But critically, they have to remit the funds within that 3-year period and remain UK resident.
Okay, a limited time offer then to bring in older funds at 12 or 15%. Interesting. What about trusts? They're often key in this area, aren't they?
Very much so. And there are big changes here, too. From April 6th, 2025, the protection from UK tax on FEG that arises in certain types of trusts, specifically settler-interested ones. That protection goes away for non-DOMs and deemed DOMs who don't qualify for that new 4-year FIG regime.
So wait, if you set up a trust as a non-DOM and you don't qualify for the 4-year relief, the income generated in that trust from April 2025.
It'll generally be taxed on you, the settler, just like if you were a UK domiciled settler.
Right, unless you qualify for and claim that 4-year window.
Exactly. So those trust structures that were very tax efficient for foreign income under the old rules, they might suddenly trigger UK tax.
Okay, and it's not just income tax, is it? Inheritance tax IHT is also changing?
Yes. The really big one for many, IHT.
How's that looking under the new system?
It's moving away from domicile entirely. The test for whether your non-UK assets are subject to UK IHT will be based purely on UK residence.
Residency. How long?
If you've been UK resident for at least 10 out of the last 20 tax years before the chargeable event, like passing away,
10 out of 20.
then your worldwide assets could potentially face that 40% UK IHT charge.
40%. Wow. 10 years isn't that long for people who really settled here. Makes you wonder.
It definitely could influence decisions about long-term residency, yes. And there's more.
Go on.
The tail period, how long you remain potentially liable for IHT after leaving the UK, that's also changing. If you lived here between 10 and 19 years, you might still be caught for IHT for a period maybe 3 to 10 years after leaving. It's complex.
Okay. And what about using offshore trusts to protect non-UK assets from IHT? That was a common strategy, wasn't it?
It was, but the rules on excluded property status for assets in trust are also being tightened.
Yeah.
Essentially, you won't be able to effectively shield foreign assets from UK IHT by putting them in an offshore trust just before you hit that long-term residency threshold.
Ah.
The status will depend on whether the settler is considered a long-term resident when the taxable event happens, even if they weren't long-term resident when they set up the trust.
So past planning might not hold up if you become a long-term resident later?
Yeah, precisely. There's a fundamental shift.
Okay, this paints a much clearer, if maybe concerning, picture for some. The UK tax scene for non-DOMs is changing drastically. Tax burden likely going up for many.
Yes, significantly in some cases.
So who's really in the crosshairs here? Who's most impacted?
Well, primarily it's your high and ultra-high net worth individuals, people who built up considerable wealth overseas before moving to the UK.
The ones who benefited most from the old R&D regime and remittance basis.
Exactly. They're now facing UK tax on their worldwide income and gains, potentially, and after 10 years, that 40% IHT risk on everything, worldwide.
And we're already seeing ripples, aren't we? Reports about wealthy individuals maybe thinking of leaving the UK because of this. I think Lakshmi Mittal's name came up.
Yes, those reports are out there. It really highlights the potential, tangible economic consequences for the UK. It's not just theoretical.
And it underlines that the abolition also means the end of the remittance basis as we knew it. That option just isn't there anymore for most.
Right. Correct. Outside of that initial 4-year window for eligible newcomers, the straightforward choice to only pay tax on what you bring in, that's gone. It fundamentally changes how international people might structure their finances regarding the UK.
So understandably, with the UK becoming less attractive tax-wise for this group, people are looking elsewhere, exploring alternatives.
Naturally.
Let's talk about some of those. Switzerland often comes up. What's the deal there?
Switzerland. Yes, most cantons, though, notably not places like Zurich or Basel, offer something called lump sum taxation, sometimes called forfeit taxation.
Lump sum. How does that work?
It's quite different. Instead of taxing your actual global income and wealth, they tax you based on your estimated annual living expenses in Switzerland.
Based on spending, not earning. Interesting. What do you need to qualify?
Okay, key things. You must not be a Swiss citizen. You can't have lived in Switzerland for the last 10 years. And crucially, no gainful activity in Switzerland.
No working in Switzerland.
Right. And there's a minimum taxable amount based on expenses like rent, which varies by canton. Plus, you need the local canton's approval. Same rules typically apply to a spouse.
And the advantages. Why choose this?
Predictability, mainly. And potentially a much lower tax bill if your worldwide income and wealth are high, but your Swiss living expenses are, relatively speaking, lower. It's based on expenditure, not income. Plus, Swiss stability and privacy are always factors.
Okay, Switzerland's one option. What about outside Europe? The UAE, United Arab Emirates, gets mentioned a lot too.
Definitely. The UAE has become a really strong contender, particularly if you're looking for a tax system outside the EU framework. It's booming as a financial hub.
And what's needed for tax residency there? Seems simpler.
Generally, yes. Spend at least 183 days a year in the UAE. Have your main home there. Sometimes you need a formal tax residency certificate too.
And the tax benefits are pretty famous. Can you run through the highlights?
Sure. 0 personal income tax. That's the big one. No inheritance tax, no gift tax. They do now have a corporate tax, but it's 9% and only kicks in on profits over AED 375,000.
So a high threshold.
Yes. And no capital gains tax on investments. Plus, lots of double tax treaties, and those free zones offer major tax breaks for businesses.
Sounds very attractive, purely from a tax perspective.
Yeah.
Okay, let's swing back to Europe. Cyprus. How does that stack up as an alternative, especially now with the UK changes?
Cyprus is interesting, yes. It offers its own non-domicile tax regime, which can be appealing if you want to stay within the EU, maybe for investment reasons or lifestyle.
Right. What are the conditions for Cyprus non-dom status?
You generally need to spend 183 days a year there. Or there's a faster route under certain conditions needing only 60 days.
60 days stuff.
But you can't be tax resident anywhere else in that same year. And importantly, you're considered non-domiciled for tax purposes for your first 17 years of residency.
17 years. And the financial perks for moving there as a non-dom.
Well, you're taxed on worldwide income, but there's a 50% income tax discount on salary earned in Cyprus if you weren't resident before. And crucially, things like rental income, interest, dividends, they're exempt from Cyprus income tax. Plus, 0 inheritance and gift tax.
Exemptions on investment income sound pretty powerful. What about actually moving there? Immigration. Is it easy?
For EU citizens, it's generally straightforward. Freedom of movement helps. For non-EU nationals, like Brits now,
Yeah.
you'll typically need an investment-based permit or maybe a work visa. Family can usually join, but there are specific hoops to jump through.
Okay. So Switzerland, UAE, Cyprus. Are there any other notable places with special regimes people might look at?
Oh yeah, a few others. Italy has its own lump sum regime, a flat annual tax on foreign income, plus some capital gains perks.
Italy.
And Greece has a non-dom system too, often tied to making specific investments in Greece, like property. Each one has its own unique flavor, its own rules.
So loads of options potentially. It's clear the UK R&D changes are making people think, and other countries are definitely competing for these individuals. For someone listening who is affected by the UK changes, what's the key takeaway message?
I think the most critical thing is, if you're potentially affected, you really need to sit down and evaluate if moving somewhere else to a country with a more favorable tax setup makes sense for you long term.
It's a very personal calculation, isn't it?
Absolutely. Depends on your wealth, where it is, your income, future plans.
No, not just tax, right? Lifestyle, family, business connections.
And I imagine navigating all these different international tax rules is, well, complex doesn't really cover it.
Understatement. Trying to do this alone is probably not advisable. Getting professional advice is absolutely essential.
Specialists in international tax and wealth planning.
Yes. People who understand the UK changes inside out and know the intricacies of the alternatives in places like Switzerland, the UAE, Cyprus, wherever, they can tailor advice, look at your whole picture, and help you make informed decisions. Avoid costly mistakes.
Sound advice. So, summing up, the UK's tax landscape for non-doms has fundamentally shifted. If you're affected, you need to understand the new reality here and seriously explore your options adapt. Or maybe relocate.
That's the bottom line. And, it does make you think about the bigger picture.
How so?
Well, with wealth being so global now and people being more mobile, how is this competition between countries for high net worth residents going to keep shaping tax policies worldwide in the future?
That's a great question. Will we see more countries rolling out the red carpet, tax-wise? Or maybe a push for more international coordination?
Exactly. It's definitely a space to watch in the coming years, how nations balance attracting wealth with maintaining their tax base. It's a fascinating dynamic.
Indeed. Something for all of us to keep thinking about.